Hi guys, in this video we are going to discuss something very interesting. So what happens is whenever the market falls, we see that a lot of stocks actually gets corrected. And that time lot of YouTuber comes with videos like 30% discount the stock is available, 20% discount, 50% discount the stock is actually available. In this process what happens is the retail investor they get tempted and then they buy those stock thinking that they are going to get the upside. But what happens is completely reverse. After the retail investor keeps buying the stock price continuously keep dipping, and there will be a certain point the retail investor get completely disturbed and then they sell the stock. So this happens for many of us, like those who are doing the market investing for at least last couple of years. Probably you have seen such things happening. Now in this video we are going to learn about a method. If you follow this method, probably you will not make such mistakes, and probably that will help you to safeguard a lot of capital. Because what happens is investing is to make money. It's very investing not to lose money. If you can safeguard your money, it is possible for you to survive in the game, and if you survive in the game, there are a high chance that you will make a lot of wealth. So this is why this becomes very important for a retail investor to understand when not to be tempted to buy such stock when there is a correction in the market. So in this video we are going to learn three such stocks, and we will understand some very simple principle. If we know that, you will never be able to make those type of big mistakes. So guys, to do that, first we will come to the screener. Now screener is completely free of cost. You can access it without having any subscription. So I have already logged in, and then let's say you want to check a stock whether it is to buy or not. Now understand that this is for the retail investor, those who are having not much idea about the business and then following some Twitter tips or any Telegram message saying that the stock is in discount. So to understand that, what to avoid, we will use screener, and let's say we'll take an example of Lotus Lab. Like probably you have heard that a lot of YouTubers, a lot of medias actually provides update about the Lotus Lab. If you see the share price for the last 1 year, from here it has been continuously dropping. Now when we compare, let's say if we just check in last 3 years, if we check it, it has performed pretty well, but after it has reached this peak, it has continuously fallen. How we can avoid falling for this trap is this simple. Let's say you always check in a duration for 1 year, because that will give you much better picture what is happening with the business. Now next is we will use a 200 days moving average. If you're using screener, this option is completely free. You can see, if you just scroll down, you can see for some of you this option may not be activated. So for that, if you just simply click it, you'll be able to find this black line, right? If you click this 200 days moving average, and after that if you follow that, the share price actually moves up and down. So in this case, if we see, the share price has most of the time when it has gone up, it has remained above the 200 days moving average. This black line is your 200 days moving average. So most of the time it has remained above the 200 days moving average. So what happens when the stock actually breaks down this 200 days moving average? This is the first place where the stock price has actually gone below the 200 days moving average. After that, if you see that the stock has not made any return, and many times when it has fallen, it has tried to come back and try to touch this 200 days moving average, but it has gone a little bit up, again it has fallen. And if you see that at certain point when it has fallen here, when at this price, when it has fallen, it has continued to fall in a very sharp pace. And in this stage, it becomes very, very difficult to find out what is the bottom. So the retail investor keep doing the bottom fishing. So this is one example where the share price goes below the 200 days moving average. No matter how much media noise has been spread, it is always prudent for the retail investor to avoid that. If you are having a deeper understanding about this business, let's say you understand this business in and out, you understand what product segment it is using, for what reason it has been falling, and whether it's a long term or it's a short term thing. If you understand those things very, very deeply, then probably it's worth giving a study. But again, you have to be very, very cautious. If it is going below 200 days moving average, you have to be extra cautious. There are high chances that the money will be lost in this case. The share price, whatever it is looking cheaper, it may look even much more cheaper with time. It is much more important that to observe when this line, this 200 days moving average, instead of falling, you can see in this case, the 200 days moving average is actually sloping downwards. As long as it remains sloping downwards, it is always good to let it go. there will be high chance that you will lose money. There is no certainty for sure that when the stock will recover, but there are very high possibility that the stock will go down. Now, I will give you another example. Now, Adani stock. Many of the investor, especially retail investor, have lost a lot of money over the stock. Now, let's see what has happened. Now, if I just see 5 years chart in this, you see whenever the stock has actually moved up, it has remained above the 200 days moving average. And after a certain point, when it reached peak, it has started falling. And when the fall was below 200 days moving average, the fall was very, very drastic. Obviously, this fall was also very much drastic. But when the stock has actually gone below 200 days moving average, the fall was very, very severe. And if anyone has trying to get the falling knife here, most of the time, very high chance that the investor has lost money. Obviously, there will be some exceptions, but majority of the case, you will see this pattern following up again and again. You may ask then at what condition we may buy? Well, in this video, we are not covering at what condition it would be ideal to buy, but this video is just to focus what condition you should and you must avoid the stock. We'll check another example. Let's say recently we have seen the following Infosys, right? So let's see what has happened in Infosys if we have followed this principle. First, let's say it isn't 5 years interval. As you can see, whenever the stock price has moved up, it is most of the time it has remained above the 200 days moving average. But once it started breaking it, you see that not much return has been made. So this is from April 2022. So you can see when it has gone below 200 days moving average, it has actually not given any return. And when last time, if we see here, the stock has broken the 200 days moving average, and after that sudden drop has happened in the stock. In this case, do you see the moving average line is sloping downwards? No, it is not sloping downwards, but it is not going upwards as well. Let's see another example. That is retail investor favorite stock, which is IEX. So if you see in IEX, if we just see 5 years chart pattern, if we see whenever the stock has grown up, the same thing, whatever I have said for the earlier stock, the same thing I can say without repeating. You see here, wherever the stock has given great return, you see it has become above the 200 days moving average. At this point, it has tried to move downwards, but it has not. It has bounced back. But the point when it has broken this 200 days moving average, you can see that the stock has not given any return. This is a very simple lesson for the retail investor. No matter how much media noise has been created, the stock is getting at 50% discount, 30% discount. If the share price has gone below 200 days moving average, and if this 200 days moving average is going continuously downwards, you have to be extra cautious not to buy that stock. I hope that gives you a very good understanding what to avoid and how you can safeguard your money. If you want to know how and what is the appropriate time to do the investing in those stock, do let me know in the comment section. I'll try to make another video for you. If this video has helped you to make you a better informed investor, do subscribe in our channel. I hope to see you in our next video. Thank you.